right. Happy Friday afternoon. We are talking about how the 2024 election affects your retirement, your investments, and your taxes. Go ahead, put all your questions into the live chat if you would like, and we'd be happy to answer all those questions for you. So please ask those questions. I'm going to go through, talk about, there's a lot of questions coming in already from people I've been talking to this week ahead of the election as well, but after the election. And there's a lot of journalists reaching out talking about the election because there's a lot of news articles on there. I'm just going to go through some of their questions they've been asking me and other financial advisors and see where things stand. Let me know any questions that you have again in the live chat. So first question is from Financial Planning Magazine, and they're working on a story about the effect about the Fed this week dropping interest rates and Trump's election. What's that going to mean for investment strategies? You're going to hear a lot of similar advice from me here, where I don't think you should be making investment choices based on politics, based on what's going on with the election. I think you should be making decisions based on when do you need the money. If you need money in the short run, you should be looking at short run type investments. When you need money in the long run, you should be looking at long run type of investments. And so that's my number one advice for you is make your decisions. I think you have a lot more ability to choose what to do with your investments, and how your choices over your investments have a lot more to do with your success than what one politician, including the president, might be. A few more questions here from Financial Planning Magazine. Were you surprised by the Fed dropping interest rates or Trump winning the election? I'm going to say no. The Fed said they're going to drop interest rates. You looked at a place like 538.com. They seem to be the best predictor of what's going on with polls. They said Donald Trump, Kamala Harris had an even chance. They both had an even chance of winning. So I think either way was likely to happen. They said either way was likely to happen. The stock market's going to be fine with either one of them winning because the stock market was up going into election. And then, of course, it popped on Wednesday, the day after election, after we knew that Donald Trump had secured the votes to win. And so you might say that the market was jumping up because Donald Trump won. I think it was more jumping up on Wednesday because things went off, as far as we can tell, without a hitch. Like, we know who the president was. There's not this 2 or 3 month long wait like there was back in 2000 with Bush and Gore and hanging chads. If you remember all the hanging chads back in Florida. Next question is, do you expect the Fed to keep cutting interest rates now that Trump has been reelected? Well, they asked Chairman Powell, would you resign if Trump asked you to resign? He said no. That's his only answer is no. So the Fed is very much trying to stay independent. They claim independence, and I think that's their stance. It's a lot of times, stop predicting what someone's going to do. Just listen to what they say, right? When Trump's saying he's going to do certain things, well, maybe things are going to shift that way in that direction. When the Fed says they're going to do certain things, it's going to shift in that direction. Next question is, how are you positioning your clients' portfolios for what you see ahead? I'm not changing anything based on what's going on ahead. There's no one passing laws yet. There's a tendency here, right? They looks like the Republicans have won the Senate. They won the presidency. They're likely to win the House. So there's a tendency there to maybe some more Republican things might be enacted as law over the next coming year or two. But does that mean you should buy one stock, sell another? I don't think so. I've seen a lot more money lost off of politics than made off of politics, where people make decisions on, oh my goodness, this person's elected one way or another, and they buy certain things or sell certain things. I've yet to find somebody. Maybe let me know. Send me a message if you're somebody that said, oh, I'm predicting that Trump is going to win or lose, or predicting that Obama or Biden is going to win or lose, and I made this bet and it won. I've seen more of the bets made that lost, and usually don't talk about those. That's what I see on there. Question is, will Trump eliminate Social Security? I think maybe it's more about, will Trump eliminate Social Security taxes? Of course, he said he would, right? Politicians say a lot of things. Interesting thing, I've heard this one probably the most this week, of how will Trump eliminate Social Security? Will that help me out? Or eliminate Social Security taxes, rather. Will Trump get rid of taxes on Social Security? Will that help me out? Well, I guess personally, yeah, if you collect Social Security and you have no taxes on a source of income, that should help you personally, right? But I just am curious if that's the right policy issue. And when I explain it out to folks, a lot of them say, well, then I'm actually kind of okay paying the taxes. Yes, a lot of people do pay taxes on their Social Security, and the taxes on your Social Security go directly into the Social Security Trust Fund. It's 50 billion a year of the income taxes paid on Social Security benefits going into the Social Security Trust Fund. And so it seems as if the same folks that would love to have Social Security on a more sound footing also would love to have taxes at zero for Social Security. And those are in direct conflict, where if your taxes go lower on Social Security, then that's less money going to the Social Security Trust Fund. So I suppose that's a decision you got to make. And of course, what I'm not voting, you're not voting on whether Social Security taxes go away or not. But just think of your own personal vote of if Social Security taxes go down to zero, go away, no taxes on Social Security income at all. That's less money going into the Social Security system. Uh, Decide how you feel about your own personal gain on the no taxes versus the society and Social Security difference on there. A few more questions. Think Advisor said, looking for a quick response on how election results might change your advice for client portfolios. It doesn't change a thing, right? Uh, Whether you should have stocks, bonds, cash, real estate, I think is more a personal decision based on when you need the money, what you're trying to get out of your money, than making a bet on the politics. Here's where things were interesting in that uh, the last few years, especially in 2022 with the stock market down and this prospect that, oh my goodness, we have until 2026 and that 22, 23, 24, 25 are the only years left at the lower tax rates, there's a lot of urgency to do Roth conversions, to take money from traditional accounts, move it over to Roth accounts, and end up paying a lower interest rate over time, right? That was the goal. There is what happens overall on that. And so when you take a look at the market at a high point and the election coming across where the Republicans maybe have swept and the same party that created the lower taxes maybe will keep it going lower, that means that the tax rate maybe will be extended. Maybe there's not that much urgency. And so we're talking through a lot of folks of, do you really have this urgency anymore to do a Roth conversion at the end of 2024? With the stock market at high rates, our high point, and tax rates being low, maybe being extended out. A few more questions here. This one's from US News. This is actually just recently. They changed the 401k contribution limits. What should anyone be doing different, at least on the 401k contribution limits? Well, to sum it up, the contribution limits are now $500 extra that you can put away um, into your 401k. So just what, if you have 26 paychecks, now you can put in roughly $20 more a paycheck. So if you're someone who's trying to max out your 401k, go in, double check, see if you can max out your 401k at that $500 extra limit. Also interesting thing too, you can put in about $4,000 more if you're 60, 61, 62, 63. So your catch-up contributions are higher. And so you might have put in a specific percentage. Okay, I'm going to put in, let's say I make 100 grand, I'm going to put in like 5% as a catch-up contribution. Well, if you're specifically for ages 60, 61, 62, 63, you can now put in more money to your catch-up contribution. So if you're those four ages, I suppose that maybe change things. If you're trying to max out, you just got a better ability to max out your 401k. Now, here's an interesting one. This just came in today. A question from Financial Advisor Magazine about they may, right? This is a proposal. There's a lot of talk out there, a lot of proposals out there. They may index capital gains to inflation for tax purposes. What does that mean? Well, what it means is if I bought a stock for 10, I sell it down the road for 20. Well, I've held on to that stock for a long time. Let's just call it 10 years. I've held on to that stock for 10 years, and really I bought it for 10. Now it's worth 20. Well, it's almost like some of that gain, that $10 gain, is really based on inflation. Like I bought it for $10 10 years ago, but really it would cost me like $13 in today's value because of inflation. So that's not fair. I have to pay taxes on the whole 10 when really like 3 of it's inflation, 7 of it's an actual gain. Well, what's my take on that? Well, we can't change it, right? We can't change the law ourselves. So this is a benefit if they do pass that law. It's a benefit to you as a stockholder. Maybe it just shows that holding stock, participating, owning the U.S. economy is usually a good thing in the long run, because this is a uh, proposed legislation that might help you out if you are a stockholder. So again, it's kind of like Social Security thing. Yep, if I'm a stockholder, if I'm on Social Security, yes, I would love that, right? Lower taxes for me personally is what you might be thinking. But then think of like the policy situation. If you're indexing how taxes might work and giving a little bit of tax break because of inflation for stock gains, are you doing the same thing for interest rates, right? If we put in this law, maybe we're kind of pitting the owners of the economy against the people who are saving, right? It's like investors versus savers. Is that really the best policy? I suppose that's what the policy decision makers and the Trump administration coming up might have to decide. But just think through. Yes, you might like that. Of course, who wouldn't like lower taxes? But what's the consequence? Is you're kind of pitting investors against savers. I'm not sure if that's really the best idea overall. So in the chat box, you can put any questions that you want here. And a few more questions coming in that I had previously from both Market Watch and CNBC. They asked me the same questions on their email list that they're sending out. If tax rates stay exactly where they are because the GOP extends the Tax Cuts and Jobs Act after 26, does that drain the urgency to make a Roth conversion now in 2025? Yeah, in a way, it does, right? If you've got maybe 10 years to make Roth conversions at a lower tax rate as opposed to just 2 years, that definitely does make the urgency go down, which is interesting. Here's something I was told. I've been a financial advisor for 21 and a half years. For I'm going to say the first 15 years, all I heard were tax rates will never go down. They're only going up. And then what happened in 2017? They passed a law where tax rates went down starting in 2018. Well, then now for the last 6, 7, 8 years, all we've been hearing is, hey, tax rates will go up in 2026. So you better do a Roth conversion now. And well, that is the law. But is that the law set in stone for the end of time? I think when you're doing these tax planning decisions like a Roth conversion or putting money into your pre-tax or your Roth, it's really helpful to have a lot of flexibility. Where you might have said, oh my goodness, the ability to do Roth conversions at the lower rates is going away in 2026. So I'm just going to convert every single thing, all my traditional money to the Roth. Well, you just gave yourself a lot less um, flexibility, a lot less diversification. Just like you should diversify stocks, bonds, the different stocks, different bonds that are out there. Maybe you ought to diversify your own tax situation. And as much as all the calculus, they said the mental calculus, go beyond the mental calculus. There's computer calculus, right? You plug into your planning software. I'm plugging into planning software for clients. Should you do a Roth conversion or not? The computer will give you an answer based on exactly the assumptions, and their assumptions are that nothing changes, and things do change. So when you look at things and the computer says, or your own calculus, if I'm going to pay taxes now versus later, I'd encourage you to keep some flexibility in there at all. Make sure you have some flexibility there. Another question came in from CNBC, emailing to me about what is the taxation of Social Security benefits, how that would help out. Yes, it would help you out personally, but remember that the taxes on your Social Security go directly into the trust fund. $50 billion in 2023 went into the trust fund from that income taxation. Another question, this is from Retirement Daily. What sort of moves might retirees want to make with your personal finances because Trump won the election? Again, investment wise, I would encourage you not to make investment choices based on who won or who didn't win. It's interesting. You find out kind of people's politics. What happens where back in 2008, Obama won, and there was a lot of people that were worried. Oh my goodness, Obama's winning. It's going to destroy my investment portfolio. Well, it did the opposite. And then you find on the opposite end some other politics there, where other people called in to me saying, "Oh my goodness, Trump won. It's going to destroy my investment portfolio. I need to make these changes." Well, and then the market went up. And then 2020, oh my goodness, Biden won. This is going to destroy my portfolio. I'm worried about what's going to happen. and I'd make some investment changes. And then the market went on up. So I'm not saying the market goes up again now, just because Trump got elected, but historically over time, it really has not mattered at all who the president was. Um, and I would make decisions based on when you need the money, how much risk are you willing to take, what do you want to do personally. A question coming in on the chat is, will it be harder or easier to retire in the next 2 years now that the election is settled? Yeah, the settled part um, should make life a little bit easier. The markets do not like uncertainty, and I think that's why the market popped a bit on Wednesday, as it seemed a lot more certain. Okay, we know who the president's going to be. We know what's going on with the Senate. A lot more people felt more settled because of that. The markets don't like uncertainty, and of course, there might be less certainty right now, but who knows what happens in the future. I would encourage you to look at your investments so far and determine, do you want to um, rebalance? If you had invested your money 3 years ago, 5 years ago, you had a certain amount in stocks, certain amount in bonds, that stock percentage is likely higher because the stock market the last 3 years has gone up significantly. The bond market is basically even the last 3 years, dropped in 22, came back up to basically even now in 23 and 24. So you probably have a lot more risk than you thought. If you are looking to retire and you're retiring in the next year, I've got a recent podcast out. I'll put that in the links here. Let me find that. I'm going to go put that in the links. Recent podcast. That podcast is what you do in the next 12 months. What should you do in the next 12 months if you're retiring? Because I've seen people back in 2019, especially. Let me grab this. There you go. That is in the chat. That's some recent podcasts about here's what you do in the next 12 months. I met so many people in the fall of 2019 that were looking to retire. And if you want to retire in the next year or two, you need to not try to eke out, okay, can I get 10% more out of the stock market and then I'll make a switch? A lot of times I talk to people and they feel as if the day that they retire is when they switch their investment risk down. I think the way that you approach things is, if you know you're retiring the next 1 year, 2 year, 3 years, 5 years, look at how much risk you have and maybe start setting aside some money so that you can retire when you want to, whether the market's down or not. And you're better off doing this rebalancing. I've got a new um, YouTube video coming out about rebalancing your investments just because of this stock market going up and bonds being sideways. I'll put that in the chat there, where the when you're planning on retiring, you don't have to wait till your exact retirement day to actually change your investments around and retire. Have your money set up the way you want to. I talk to people all the time. It feels like that's the case. Two people just recently, they had over 90% in the stock market, 99% in the stock market, and they want to retire in the next few months. That has done them phenomenal for the last 15 years. But if they are planning on taking out 5 grand, 10 grand a month from their investments, just 4, 5, 6 months from now, is that truly the best case for them? And of course, this is for you personally. For them, it was not. And what happens, and one of them already actually done this, they took all their stock investments and switched it all to cash. Usually the answer is not 100% of one thing. So when you're planning out your planning out your investments, things going forward, you want to keep an eye on when do you need the money and how much risk do you want to take. So I've got a few very recent podcasts and a YouTube video about plan out when do you need the money. If you need money in the short term, you should match that with short-term investments. If you need money in the long term, you should match that with long-term investments. I don't think you should wait until exactly your retirement age to start pulling some money out of the long term towards the short term, because your short term's coming up. If it's a month from now, 1 year from now, your short term's coming up. So take a look at that, those YouTube videos and the podcast about that. I've seen people, one person in particular, and that's a story in the video. One person in particular met him in fall of 2019. He said, I want to retire in 5 months, but I'm going to make all my moves when I hit retirement. Well, what happened in March of 2020 is the stock market dropped 30% because of COVID. So he emailed me in March of 2020 and said, well, I can't retire April 1 like I wanted to. I will plan on retiring a year from now. And then I want to cut my investments in half. He wanted to cut his risk in half after the market had already dropped by 30%. And I'm not predicting that the market goes up or down going forward. What I'm saying though is if you know you need some money soon, why are you waiting? Why are you waiting until your retirement date to make any changes? And here's another reason. When you plan for your retirement going out, you often retire 3 years earlier than you expect. If you ask the average retiree, when might you retire, right? If you talk to a 55-year-old, say, when do you plan on retiring? They'll often tell you 65. But if you ask a 65-year-old, when did you retire? They would tell you 62. Most people are retiring at 3 years earlier on average. So that's my encouragement is right now, as you are looking at your investments and you're wondering what to do based on the election, I would encourage you not to do anything based on the election. Look at things based on when do you need the money? And if you need money in the short run, make sure you have some short run type of investments. If you need money in the long run, right? Retirement doesn't mean you switch every single thing from stocks to cash. You are likely to need some money in the long run. So you might want to keep some long run money that's out there and get that set up. Get that set up 3 years ahead of time because on average, you will retire 3 years ahead of time. Thanks for coming out to the Mr. Retirement Election Edition YouTube live. I will be talking to you soon. Make sure you subscribe and we'll be getting those. There's just a video coming out here in the next few minutes. Enjoy your day.